Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and we're getting an update today from Robert Sinn, also known as Goldfinger on CEO.ca and CeoTechnican on X/Twitter. He's also the publisher of Goldfinger Capital on both YouTube and Substack. And Robert, it's great to get you on the show here on a Friday, although we'll be putting this out as a special feature on Sunday for people listening in, just to get your thoughts on a missive that you penned to your subscribers, and it was titled, "This Time It Really Is Different." And you were talking about the range of macroeconomic factors, everything from the Fed to the markets to what we're seeing, kind of the speculation in the markets and mega cap tech stocks, and then also the geopolitical environment and the globalized trade kind of breaking down into a multipolar world. There's so many different threads to pull on, but just explain to us why it really is different this time.
Yeah, thanks for having me on again, Shad. Yeah, last weekend, I do these weekly videos. And so every Sunday, Monday, I have to think about, what am I going to say? What's really poignant this week? And it really struck me how it really is different, And I know that whenever a trader, portfolio manager, market observer says that it's different this time, everybody's like, oh, no, contrarian time. He's wrong. We got to fade that. But I didn't really mean it in the sense like stocks are going to go to the moon, like 10,000 on the S&P, or gold is going to 3,000 next month. I didn't mean it like that. I meant it like just this whole stew that we have today in the macro backdrop. It really is different this time. And from a stock market standpoint, I'm looking at this market breadth. There's a lot of graphics that you can pull up to see the market breadth, but basically the number of stocks that are making new highs in the S&P 500 or the Russell 2000 versus the stocks that are not at all making new highs. In fact, some of them are breaking down to multi-month or even 52-week lows. I mean, it's such a extreme divergence. There's so many stocks not doing well in the last couple of months, basically since the end of March. FedEx has not been doing well. A lot of airline stocks are breaking down, right? And I could go on. There's a lot of sectors of the market that are not doing well, yet S&P 5425. We're basically at the all-time high here on the S&P. And we know that Microsoft and Apple and Nvidia are the leadership. They're the ones powering the market to new highs because they're the $2 and $3 trillion market cap companies. But we've never had this market we have today. Yeah, we had the Nifty 50 back in the 70s, and that was 50 stocks that led the whole market. But that was 50 stocks, and those were companies that made America great in the 70s. Right now, we just have 6 tech stocks. That's our market. We got 6 tech stocks, and it's global domination by the Magnificent Seven. And I'm not even sure it's 7 anymore. I think it's 6 now because Tesla's not really doing that great, right? So it's amazing to me. And then I'll add in the whole meme stock thing. And the Roaring Kitty guy came back last month, and he's been active, and more people tuned in for his YouTube live than watch some professional baseball and basketball games. When has that happened before? The stock market grabbed that sort of attention on a Friday afternoon. So a guy talking about GameStop, the company GameStop, which is not even really a relevant company anymore, but it's a stock, and it's a meme stock, and he likes the stock, right? And the stock is really volatile, and people like to trade the stock. It's a casino, right? So this market, it really is different this time. And people can argue with me and say, no, it's not, blah, 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 but it really is different. And I won't even go into the whole backdrop of Russia and Ukraine and all of that. This is a unique time in the world.
Yeah, and they're not even stocks anymore. They're now stonks because because the Reddit armies and the apes. So there was a guy that put a meme out during the Roaring Kitty webinar that so many people attended, and the meme was him taking a picture of the book The Intelligent Investor by Benjamin Graham and throwing it in the trash can. And that started trending, because the whole idea that we would be listening to somebody talking about a meme stock on a game company based on gamma options trading and all these things on a stonk instead of intelligent stock investing is kind of a brave new world that we're in. Have you ever seen a time, Robert, where we've seen the valuations so heavily weighted towards forward earnings. Like when you look at Apple, when you look at Nvidia, when you look at Microsoft, they're pricing in perfection way out into the future. Does it mean that we just need to adjust our models and that all of these companies, we need to have higher valuations? Or is there a tipping point that some of these valuations are getting to?
I mean, I can't get my head around it. I mean, with Apple, it's 30 times earnings with zero growth. And, some analysts are pointing to, well, they're going to have a big upgrade cycle. Like everybody's going to have to get the new iPhone for Christmas this year. So their Q4 is going to be a blowout. Okay, maybe, but we're not there yet. And 30 times earnings for no growth for $3 trillion market cap, that seems extremely pricey. But it doesn't matter what I think. And I agree with that. Throw Benjamin Graham, throw all that CFA stuff that I spent 2 years of my life studying and wasting my time on. Just throw it all out the window, because it doesn't matter. I don't think, it might matter in the ultra long term. Like if we're talking about 5-10 year time frames, yeah, that Warren Buffett quote will probably come into play undoubtedly, but who knows what will happen in the world 10 years from now, right? And so the fact that GameStop can go to like $20 billion market cap on just nothing because the guy is posting tweets about it is pretty wild. I mean, it's insane, really, quite frankly. And yeah, this is like a market I've never seen, and I just think with the mega caps, I think it's just portfolio managers are piling in to what's been working. And those stocks continue to work and they're performing. And so everybody has to chase for the performance and own those stocks. And if you don't own those stocks and Apple goes up 7% in the day or 13% in a week, well, you might lose your job as portfolio manager because they're underperforming in a big way, So everybody just has to own those. They're hedge fund hotels. They're relatively safe. They have fortress balance sheets. They have low cost of capital, yada, yada, yada. Forget about whatever the valuation is, $3 trillion. I mean, soon we might be talking about a $4 trillion market cap. Who knows?
Well, I think you make a great point that a lot of these fund managers or people that are allocating other people's monies are pretty much forced to being in these, even if they're shaking their heads, even if they're saying, wow, these valuations don't make sense. They'll be punished if they're not in them. And I think the Warren Buffett quote you're alluding to is that in the short term, the markets are a voting machine, but in the long term, they're a weighing machine. So maybe over 5 or 10 years, some of the froth comes out. But hey, it's even spilled over into the commodity sector, Robert. When you think about the AI narrative, I mean, AI has been around since the 50s and 60s in some form or fashion, but suddenly it really broke out over the last year where, wow, AI, and every company wants to mention it in a press release, and if they do, they get a little bump. We're not really seeing it in the earnings yet, but that AI narrative, finally people realized, wait a minute, if we build all these data centers, we're going to need a lot more power. We're going to need a lot more. So that spiked the punch bowl for things like nuclear power and uranium, for natural gas getting a little rebound. You've seen silver get a little love recently, not just because gold's breaking out, but also solar panels and the solar farms they're going to buy. Do you think the AI narrative is helping commodities in that sense about the power side of things?
Well, certainly the AI narrative has been injected into copper and silver and in junior mining pitch decks from a marketing standpoint. We've seen that in the last couple of months in a big way. Is it actually affecting the share price of companies? Is it actually moving the price of copper today? I'm a little skeptical of that. But yeah, it could definitely have an impact over the coming years. I forget what the exact data point is, but I think it's every one of those AI data centers requires like 40 tons of copper, if I'm not mistaken. So when you think about, or it might be 400 tons or something, but it requires a lot of copper. Right? But when you think about, well, every single one of those data centers does require a lot of copper. All these solar farms require a lot of silver. All the solar panels require a lot of silver. So it definitely does have an impact. We're just not clear on how much of it, like an impact it's actually going to have. I think this is still more of a future thing where we're looking out at the forecast, where if we're going to build this number of data centers across the globe, so we're not just talking about here in the US, we're talking the entire world. If we're going to build this number of data centers, well, how much more copper will we need to build those? And then people are putting together those graphs that we all love that shows the copper supply looking out 10 years is flat to down. That's the forecast. And then, for wind power, we're going to need this much copper. For data centers, we're going to need, this much copper. For solar farms and tying them into the power grid, we're going to need that much copper. For EVs, and then suddenly, we are facing a deficit of 1 million metric tons 10 years from now or something, right? Like something substantial. And actually, I think the deficits that we could be facing are much more than 1 million metric tons 10 years from now. It could be more on the order of 10 million metric tons. But anyway, it's a big number, and nobody knows where we're going to get all that copper from. But I really don't think it's in the copper price today at, whatever, $4.48 a pound. I think it's more just like speculation and a little bit of marketing hype. We'll actually have to see if it actually happens.
Yeah, great point. And I think a lot of times these narratives shift. If we just think back a couple of years, it was about the crypto mining and the power requirements there. We're going to need so much more copper and energy commodities. And then it was EVs and all the power grid. Those things are still there. It's not like EVs went away or crypto mining went away, but now we have this whole other layer with AI and the data centers. And it's become a big narrative that even the press is picking up on, even mainstream media talking about the need for copper, the need for more nat gas plants, the need for more nuclear power and uranium, and all those different commodities tie into it. It doesn't necessarily mean it's a now thing or that it's showing up at the price today, but we should talk about pricing. And I'm going to have you put on your technician hat and just look at the moves we saw in gold and silver and copper. Let's just look at those three. As they shot up, gold broke out to a new all-time high. Silver finally broke 30, which we've been waiting for since 2013, got up to 32, 75 roughly, and then came back down. Copper broke out to a new all-time high up to about $5.20 a pound, and then it's fallen back down. A lot of people were just getting excited. They were just getting the animal spirits back, and then once again, the rug's been pulled out from underneath us, Robert. What do you make of it?
Well, I've been consistent since mid-April when I made a video in the middle of the market day on a Friday when I said gold hit 24.48, and I said, okay, that's it. We're in for a correction now. It's too far too fast. I nailed it to within the hour. Since then, we're in a corrective process. Now, even though gold did make a marginal new high slightly above 24.50 in May, I think that was still part of the corrective process. I still think we're in it. I still think we got a few more weeks of slog left. I know some guys are looking at like that gold daily chart. They're saying that's a double top. We're going to break 2280 and gold's going to crash back to 2100. Everybody's caught here. I disagree with that. I think gold is going to do what it does best, which is inflict the maximum amount of pain among the maximum number of market participants. And gold futures, the futures market more generally, is a mechanism. It's a wonderful tool for transferring wealth from the many to the few. And that's what gold is going to continue to do here over the next few weeks. And probably at some point at the end of this month or early next month, we're going to get in a situation where gold is going to have a reversal to the upside. We'll have a key reversal day at some point. I'll say in the next month, so I'll give myself a little bit more room there, where it will like drop to 2250 on like an intraday, run all the futures stops out under whatever 2280, because that's the support. So everybody's going to have their stop under the support. They're going to run all those stops, and then it will, reverse and close back above 2300 in the same trading session. And that will be okay. The correction's over, bull market on again. But until we get that sort of washout to cleanse the spirits of the market, we're still in this slog where I don't think we might rally to 2350. We might sell off to 2300, but it's still in a range, and it's not really moving me off of my thesis at this point. I think copper, copper and silver are sort of similar because, like, I don't know why copper went to 520 in May in a vertical ascent from $4 in March. And I also don't really have a thesis for why it's going to go back there in the near term. I think we're sort of in the summer doldrums here in copper. And if it's trading at 440 or 450, that's fine. Let it just, sit here and build out a base. And then we'll see, then we'll see if these, supply dynamics continue to persist where we're undersupplied and new mine supply growth is just not there. then we'll go back above $5. But I think we need to wait a little bit. I think we need to be patient here on the copper trade. And I can sort of say the same thing about silver. I posted a chart on X, silver weekly chart a few days ago, and I just said, look, the support is 29. Maybe it's, you sharpen your pencil, it's 28.75. That's sort of my big level on a weekly closing basis. So as long as we're holding there during the seasonally unfavorable next few weeks here in June, that's fine with me. It's at the 50-day moving average. So it got super overbought in May. Everybody got bullish again on silver at $32 an ounce for some reason. And I'm not even clear why it went from 27 to 32. I think that was just the futures market doing what it does. It had to run some shorts out of the market, and we did that, and now we're coming back. But bigger picture, so I'm talking daily charts, I'm talking about the next month there in that conversation. Bigger picture, I'm bullish on all these metals. So when I'm looking out a year, 3, 5 years, I want to own copper, gold, and silver for the long term.
Well, let's carry it over into our beleaguered mining stock world, the resource stocks, which actually have had a little more life in them this year. So talk about a rough slog. It's been a couple years of a rough slog with the mining sector and the resource stocks, but a lot of them did spring to life when gold broke out, when silver broke out, when copper broke out. We saw some movement. Some of the stocks up 100%, 200%. The indexes like GDX, GDXJ didn't move as much. SILJ finally got into gear for the silver stocks, for the juniors. And we did see probably the best move was in COPEX, the senior copper producers. They were already consolidating a big move they had a couple of years ago and then blasted up to the next leg of it. But when you look at it now and we think about Q2, we're not quite done with the second quarter. But when we think about where these metal prices are as an average price for the quarter, most of the big boy producers should be making some pretty fat margins here. Do you think that gets on the radar of analysts? Do you think more people that are generalists start noticing, hey, these gold and silver and copper companies actually are making money at these levels, and then that brings more capital down into the juniors eventually? How are you looking at it?
We can only hope, Chad. We can only pray. I think you're on to something there. And what I've noticed is Newmont, which is the world's largest gold mining company, and also, significant copper miner as well, especially since they acquired, Newcrest. They got a few copper mines there, in Australia. So I have been watching Newmont display relative strength since its February bottom at that washout at $29 a share. It's holding above $40 a share. Even like last Friday, gold was getting taken to the cleaners down $90 an ounce, and Newmont was still holding support at $40 a share. So I took that as a bullish sign that there are institutional investors buying the world's largest gold mining company here. There is an accumulation that's underway, and I think they are seeing exactly what you just stated, and they are looking. Their quantitative models are already seeing that Newmont's going to have better quarters ahead, and this company might finally be positioned to, dare I say it, outperform and actually deliver on earnings growth. We'll have to go back to this conversation following the next quarterly report and see if that actually happened. But I think you're absolutely onto something. I mean, 23.30 gold, 450 copper, $29 silver. These are good metal prices where companies that have highly efficient operations can generate substantial free cash flow. And this is time for the sector to deliver for their shareholders. After several years of disappointment and underperformance that has sunk investor sentiment on the mining sector through the floor, it is time for these companies to generate the earnings that will help to drive their share prices higher.
Yeah, Robert, I'm imagining Tom Cruise screaming, "Show me the money," as you say this, because for the longest time, the mining sector hasn't shown investors the money. They haven't shown that they've been able to earn the kind of money people would expect at higher metals prices. And so many investors are like, wow, look at the prices of these metals. Why aren't the companies doing better? But that's because their costs have crept up higher and higher, and it's eaten into the margin. So hopefully we see a good quarter that maybe surprises for the first time, and that we show the generalist markets that the mining sector can make money. I'm going to throw it over to you just generally on the juniors. You've been on a lot of site visits. You've been traveling around like a madman. You've been visiting companies. You've been interviewing company CEOs. I see how busy you are on your different channels and platforms. Are there any trends in the juniors, whether they're gold or copper, just is there any trends that you see maybe having some legs that not as many people are paying attention to yet, but you think that there's some growth opportunities?
Yeah, well, you can pull up my Substack, Goldfinger Capital on Substack. And by the way, I really have been enjoying your Substack, Shad. You put out a lot of really in-depth, well put together content in the last several weeks, and I really appreciated that. But you can pull up my Substack, and you get the theme that I've been on for the last several months. A lot of it is copper and gold. A lot of it is porphyry stories, the companies that are exploring copper, gold, moly, porphyries throughout, the Americas, I guess I say more broadly. And I'm still sticking with that theme. We had some nice moves in 2023 and in the first part of 2024 in some of these companies. But I think we're just getting warmed up here, really. I still think this is early days, to use kind of a tired expression, but I really do think that it is early days. And certainly the last month in the junior mining sector has been pretty piss poor. Yeah, we had a good run in April and May, but here we are in mid-June, and the tape looks pretty dreadful again. And a lot of company share prices have dripped lower to where I think there's a lot of attractive opportunities again. So those of you, I'm not going to name an individual stock, but you can look at my Substack, lots of ideas there. Again, please do your own DD and don't count on me to give you the best ideas. But I think there's a lot of opportunity here. I think there's a lot of opportunity. And for those who are paying attention and talking to company CEOs, as our last conversation, call the CEO, actually ask the tough questions, ask how they're able to raise capital, who their backers are, who the biggest shareholders are, what their plans are for the funds that they're raising, how they're going to spend the money, and do all that background work you have to do as an investor. And then why they like their projects. And one of the most important questions, well, why are these the projects in your portfolio, and how are you going to advance these and generate value for shareholders? Like, what are the catalysts, and how much is it going to cost, and when are we going to get those questions answered, right? All very important questions for investors to ask to junior mining CEOs. But I think there's a lot of opportunity right now, much more opportunity at more attractive valuations than even there was 1 month ago. Like, this little June downturn that we've seen has really put out some really attractive opportunities.
Man, it's such a great point, Robert. We'll wrap it up with that point, because there's a lot of people that were starting to say, oh man, I've already missed this run. It's running away from me and I don't want to chase. And now things have pulled back down where you got another crack at the piñata. So a good time for people to be looking at their watch list, looking at their portfolio, asking those questions, looking at what are the unanswered questions. Do they have the budget to go after it? Is it achievable in this year's work program? Some great thoughts there. And if people like getting Robert's thoughts, definitely click on some of the links below this interview. It'll have a couple ways to go see his various platforms and all the research and all the interviews he does with companies, his macro take on things, and also his technical take on things. So, Robert, always great having you on the KE Report. And just like always, man, looking forward to our next conversation.
All right. Enjoy your weekend. Thank you.